Hello, Accounting 230. This class today, this Tuesday class, is going to cover Chapter 8 on depreciation. When we get done today, we will have gone through Chapters 6, 7, and 8. And I just want to let you guys know that I'm planning a test review on Friday. We will go through Chapters 6, 7, and 8 in any kind of detail you like. I'll give you some pretty good ideas, some templates, and some tips to get you through these three chapters. I see we have our first visitor. Brianna, how you doing?
Doing well. How are you?
Oh, good. I didn't have to tell you to unmute yourself, so we're off to a very good start here. I was just I just got in here a moment before you, Brianna, and you heard me say Friday we'll have a test review for those who want to participate. Okay. And today we have Chapter 8 on depreciation. Hey, didn't I tell you Tampa Bay would murder the Chiefs? Remember you heard that, right?
Yeah, I didn't watch.
Shame on you.
I know.
All right, here we go. Okay, let me just set this up Bob's style here. Okay. Here, we're still going through our balance sheet, okay? Chapter 6, we learned quite a lot about cash and accounts receivable. We learned about the contra accounts, like the allowance for bad debts and sales discounts and net sales. Chapter 7 was all about costing of inventory, cost of goods sold. So here we go. We're dropping down into fixed assets, long-term assets. Property, plant, and equipment, natural resources, and intangibles. I'm going to start by saying this, and hopefully you can look at this later and remember it. You depreciate property, plant, and equipment, you amortize intangible assets, and you deplete natural resources. Those are the three accounting terms. Okay, long-lived assets. I think we know what these are. These are cars, vehicles, buildings, land, equipment, and they're tangible, huh? We can touch them. They're right out there. We know we can touch these things. But you also have intangible assets that you cannot see. They are not visible. They are things like patents, trademarks, copyrights, goodwill, intellectual property. Those are assets, and we're going to amortize them just like we depreciate tangible items, okay? Long term, well, here we go. I guess I got a little bit ahead of myself. Land is never depreciable. You never depreciate land. That's an accounting rule. Assets subject to depreciation, the big guys, buildings and equipment, furniture and fixtures, the list goes on. Natural resources like water, oil, like they have here, mineral deposits, timber, those are depleted. We use them up, we deplete them. And intangible assets have a definite life. Patents are 20 years, copyrights a certain amount. You don't have to memorize how many years of life these have, except perhaps for a patent, which is 20 years. And they have definite life. They have definite life and then indefinite life, trademarks and goodwill. So I'm kind of starting off here with a couple basic things. Take a look at your balance sheet here. Here's the section on fixed assets. They're starting you off with the current asset total. And now this company, Southwest Airlines, has flight equipment. They have property and equipment on the ground. Those are the carts those guys are driving around, the baggage handlers. And they've got some deposits down on some purchase contracts. And they did some of their own construction. And the total asset balance for the equipment and everything is 22 million, less the allowance for depreciation and amortization. Acquisition cost. Let's talk about this a little bit. It'll be on the test in the form of a couple of questions, I bet. Acquisition cost includes the purchase price of the item. Well, we know that. but it also includes any expenditure meaning cash outlets, outgoes needed to prepare the asset for use. Okay. And then they want to complicate things with this does not include financing charges involved with the purchase. So I think we can ignore that. Acquisition costs, purchase price, maybe, maybe not, depending on the state. There'd be sales taxes. What if you bought an airplane? What if Boeing bought an airplane from somebody? They're going to have that plane transported in. That's a cost. Any legal fees, realty, or installation costs. You bought a new machine and you bring it to your factory or your store, and you can't use it yet because it has to be properly installed by your electricians, perhaps. That is all part of the cost of the asset, okay? And what we're saying is we're capitalizing those expenditures. Capitalizing, meaning we're putting a cost on the balance sheet, okay? And they're given a few more examples. Equipment has a purchase price, installation. Maybe you had to knock a wall down in your building to get this giant machine in. Buildings, purchase price, renovation, etc. Land has all these different fees, and it is not ever depreciable. So we're going to start off with acquisition costs, okay? And we're going to run through a couple of scenarios here. In this example here, Southwest Airlines bought an aircraft from Boeing, I'm going to guess, huh? Southwest Airlines purchased an airplane for $75 million, huh? And Southwest had to make a down payment of $1 million, and they financed the rest with a note payable. So let's take a look at our journal entry, huh? And here's where this course goes a little bit off with the slides. We were just talking about the 1 million and the note. Here, they're just showing you a basic cash purchase. They can purchase for cash, huh? So here we go. Southwest Airlines purchased aircraft for $1 million, took a note out for $74 million. And again, this thing is messing with us. Thank God, there it is finally. On January 14th, they bought the aircraft, credit cash $1 million, credit the notes payable $75 million, and debit the asset for its full cost. Acquisition for non-cash consideration. Record at the current market value of the consideration given or the current market value of the asset acquired, whichever is more evident. Let me make this a lot easier for us, okay? Here's an example of what they're talking about. Southwest gave Boeing 1 million shares of $1 par value stock at a time when the market value was $50 per share. So Southwest said, how about we pay you this way? Boeing said, okay, we'll take that. So let's look at our journal entry. We're going to we're going to debit 75 million to the aircraft. And we're going to do this. Debit flight equipment, credit the cash. And remember what I've said a bunch of times about common stock. The common stock line on your balance sheet will always be a multiple of the par value. So 50, so many shares at par value, million shares par value, and there is your journal entry. And we don't get into this in too much detail, but you can build your own fixed asset. And all of the materials and labor traceable to the construction of that asset and some overhead reasonably calculated on a systematic and rational basis, the famous accounting statement. Interest on debt while you're building is part of the cost. I can give you two examples of my world, one where everything went great, the other one where the auditor beat me up a little bit. When I was with Thomas and Betts, our factory in downtown Los Angeles was destroyed in the October 1st, 1987 Whittier earthquake. We were allowed to remain in the building only till the end of the year. And then we had to abandon it. And the building was to be knocked down. We ended up buying another building in Baldwin Park, California. And we had to spend a ton of money getting that building ready. We had to wire the place and put in the fixtures. You can imagine how much money that was. It was a big deal. And the bosses back in New Jersey gave me a little guidance. They said very aggressively capitalize everything you can. And so I capitalized everything that I thought was associated with building that, including something as trivial as the bagels we used to buy for the work crew every day. The bagels wouldn't have been bought without the building there, right? So the auditors looked at it at the end of the year, and they said everything was fine. When I worked at the Santa Barbara Neighborhood Clinics as the CFO there, we built a new clinic on East Side, and I did the same thing. And the auditor killed me at the end. He said, you can't put these little tiny coffee break stuff in there. So one man's capitalizing is another auditor's expense. Here is an important thing to understand: the difference between a repair and an improvement of an asset. Okay. Hey, Justin, how you doing? Welcome aboard, pal. So we have repairs and we have improvements. An ordinary repair, the basic things you do to keep the equipment in normal operating order. By spending this money, it doesn't increase productivity. It doesn't extend the life of the asset. It's probably recurring and small dollars. For example, a car. You have a car and you change the oil every 3,000 miles, okay? You get a tune-up once a year. You rotate the tires, things like that. You're not improving the car. You're just maintaining it in the position it's in right now, okay? So all ordinary repairs and maintenance is an expense. It's an expense. You can't put that on the balance sheet as part of the asset. You can't change the oil in the car and then say the car is worth $50 more. Now, an improvement is a major overhaul. Doesn't happen very often, and it very definitely improves the asset's efficiency and likely its useful life. We're talking bigger dollars. You go back to that same car. Well, now you overhauled the engine. You put in a whole new fast, speedy horsepower engine. You put a new transmission in that thing. Well, that car has really been improved. So that would be a capitalized item. Those costs would be debited to the car. You would debit car, the asset, okay? Difference between a repair and an improvement. Need to know that. And they're giving you another look at it here. Expense goes on the income statement as soon as it happens, and it's going to lower your income, right? It's going to lower your income, but it's also going to lower your taxes. If you had $1,000 maintenance expense, well, you're going to save 30% of that. You save $300 in taxes, as opposed to an improvement where you capitalize it on the balance sheet and the expense is deferred. Remember the deferred expenses when we're doing adjusting? One of the deferred expenses is depreciation. So your income's going to be higher and you're going to pay a little more taxes, okay? And this is a good tip on the bottom. To aid with capitalized expense decisions, many companies record all expenditures below a certain dollar amount as expenses. And that's exactly what I've seen in my illustrious past. Huh? Okay, let's continue along here. Question from Brianna in the back row. Yes.
So when you're putting an asset in at historical cost, that's what you originally paid for it, but then it can be changed only by these major improvements?
Absolutely, because it's considered a new asset in a way, right?
No, but you're just adding it to the historical cost.
Yes,
I mean,
yes.
okay.
Yeah, that's a great question, because I've been emphasizing you never increase the asset value. It always has to be at its historical cost. Well, this is just additional historical cost. Maybe think of it that way, Brianna.
Okay, perfect. Thank you.
Okay. And let's have a little bit of fun with another accounting fraud. WorldCom, back in, I don't know, in the late 90s. No, here it is, 2001 and 2. What this company did, they were kind of a startup, and they committed a fraud where when expenditures that should be recorded as expenses are improperly capitalized, the effects on the statements are enormous. WorldCom inflated its income and cash flows from operations by billions of dollars. What these guys did was they capitalized everything. They capitalized almost $4 billion, and it made it look like they were making tons of money. And the reality was that they were not. So this is another company that crashed to earth. And the boss of this place, I believe was the Bernie Ebbers company. Ebbers, he's still in jail. He's serving a long prison sentence. Okay, let's get to depreciation. We know how to do straight line depreciation already. We're going to learn a couple other methods here. Depreciation is a cost allocation process. We know that. It systematically and rationally, there's that term again, matches acquisition costs of assets with the periods benefited by it. That's a long-winded way of saying we bought an asset for $1 million. We're depreciating it over 10 years, $100,000 a year. Okay. So you buy the asset, and as soon as you start using it, you're allowed to reduce not the historical cost, right, Brianna, like we just said, but you are going to reduce what's called the net book value, the original cost of the asset less the accumulated depreciation. So you buy the asset January 1st. At the end of the month, you've got some of that asset being recognized as an expense. Okay. Depreciation expense is just that. It's an expense. It goes directly to the income statement. Accumulated depreciation is a contra asset account. It's an outlier. It's an account. It's an asset account with a credit balance, just like the allowance of doubtful accounts was a credit balance. It was an outlier. It was a contra. So that's what we have here. As you know, all contra accounts are married to another account. Accumulated depreciation is married to the equipment. The original cost of the equipment less accumulated depreciation equals your net book value. Keep in mind that depreciation has nothing to do with market value. Nothing to do with market value. Nothing to do with that. Land you bought many years ago that's worth 10 times more today is still carried on your financial statements, on your balance sheet, at the cost of that land. You don't show the profit until you sell it. The remaining balance sheet amount probably does not represent market value, and the under depreciated cost is not measured at fair market value. Okay. Depreciation is an estimate. Let's understand that it's an estimate. Yes, we have some estimated numbers on our financial statements. Well, an adjusting journal entry is needed at the end of each period to reflect the usage of our assets. And this is the easiest journal entry in the world, I keep telling everybody, because it's always the same. You debit depreciation expense, which is an expense, and you credit accumulated depreciation, which is an XA, a contra asset. Okay. Now let's talk about these three things here we need to know. Before we can depreciate an asset, we have to know how much we paid for it. What is the acquisition cost? Like with those airplanes, they paid 75 million for the airplane, but maybe they paid another million to paint the plane they wanted or do something special after they got it from Boeing. We need to know the useful life of the asset. And again, that's an estimate. We're going to guess it reasonably how long this asset will last. And the residual value, known as the scrap value, just how much we think someone will give us for this asset after it's fully depreciated. Okay. And we're going to learn two new depreciation method here, units of production, and then an accelerated method called declining balance. Please put the word double in front of declining. Please start referring to it as double declining balance. And you'll see why. It's going to be double whatever the straight line rate would have been. So we'll get into that in a moment. Straight line, I think we know this already, that you do not depreciate the residual value. So here's Southwest bought some ground equipment and they're going to depreciate it for 3 years. And they have a residual value of 2,500. And what they're saying is, we're going to beat the heck out of this ground equipment 24/7 for the next 3 years. And then it'll be time to replace them. And we think somebody will come in and take them off our hands for 2,500, junkyard or somebody. Okay. So we're only going to depreciate the 60,000. And that's what we're seeing here. 62.5 is what we paid for this ground equipment. We deduct the residual value. So that becomes 60,000 or $20,000 per year. $20,000 per year. This is just something to look at briefly. Nothing to worry about test-wise. But it's interesting that Southwest and United and Continental have merged. They estimate their planes 25 to 30 years. Singapore Airlines is only 15. Does that mean Singapore's planes are much safer because they're replacing them every 15 years? Not necessarily. Not necessarily. It just means they are allowed to get away with depreciating 15 years, and that plane probably will last the same as Southwest and United. Straight line. Back to this again. Okay. Get used to this grid here. Get used to this grid. You are going to have the upper right. You're always going to put here the original cost of the asset, including the residual. Okay. So we paid 62.5 for this. So we're using straight line. We know that the expense every period is 20,000. And we know the accumulated depreciation is also 20,000, but this is an asset. So that's going to be 20, 40, 60. And here we go. Let's take a look. First year. Net book value at the beginning was 62.5. We depreciated at 20. These two columns are your journal entry. You debit depreciation expense for 20,000, credit accumulated depreciation, and the balance of that asset, that contra asset, is now 20. And the net book value is down to 42. So let's see the end of it. Okay, 62. And then we expense 20. That got us down to 42. We had the same journal entry 3 times. This is your journal entry, these first 2 columns. Here is the balance in the accumulated depreciation. It went from 20 to 40 to 60, and it left a residual value of 2,500. Remember, you do not depreciate the residual value. And another way to say that is you can never have a net book value below the residual value. Okay? No matter what the method is. Okay. Units of production. Let's take a look at this one. You bought a car and you're going to estimate it, the depreciation on, say, the miles. Okay. So here we're working with the same 60,000, but we're going to divide it by some kind of units. Okay. So look what we have here. We have Southwest purchasing ground equipment for 62,500. And they estimate that this equipment is going to cover 100,000 miles. Those are your units of production, the miles. So let's see here. We got 62.5 minus 25. It looks to me like that would be 60 cents a mile if I did that in my head, right, huh? So the first year, they drove 30,000 miles. 30,000 miles. Notice that the grid is pretty similar, okay? Except over here, they're showing you the miles driven. We are depreciating this ground equipment at the rate of 60 cents per mile. So at the end of the month, someone has to tell you in accounting how many miles this particular machine or car or truck or whatever, how many miles it drove. Again, back in the old days with me again, it's always all about me, huh? Yeah, our salesmen, they were required to send in the mileage on their vehicle, and that became the basis of our depreciation entry. So 62.5 minus 18 gets you down there. Here, they drove the car 50 and 20 for the next 2 years. Take a look at this here. 60 cents a mile times the 30,000 miles gives you the 18. I love how they repeat these slides unexpectedly. I have no ability to change these slides, by the way. Anyway, so the first year they drove 30,000 miles, then they drove 50. 5 times 6 is 30. They drove 20. So after 3 years, they recorded $60,000 worth of depreciation expense broken out by year. The accumulated depreciation went from 0 to 18, went up another 30, etc. And there we are. We're down to the residual value. You can never go below the residual value, okay? Let's scrap that idea. You can't go below the scrap value, okay? Now, here's one where we got to think a little more. Accelerated depreciation methods match higher depreciation expense with higher revenues in the early year of the asset's useful life, when the asset is thought to be more efficient, okay? And companies use this, certainly, because they can front load a lot of the depreciation expense and reduce their income in the early part of the life of the asset and save taxes that first year, etc. So here we go. Depreciation expense. The theory is early in the asset's life, you don't have too much wear and tear, so you can justify low depreciation. Later years, the repair expense is higher. Let's look at the rule here. Double declining balance. I can't emphasize that enough. Call it double declining balance because the rate is always double what the straight line would have been, okay? And we're going to talk a little more about that. So on this method here, we have one exception to our rule. Here, we are going to depreciate. Let me say it this way. We are not going to deduct the salvage value, the scrap value, okay? We are going to take that 62,500, and that's going to be our base, okay? At the beginning of the year, the annual computation ignores the residual value, and that is going to bring us to another little difficulty in a moment. At the beginning of the year, Southwest purchased equipment for 62.5, estimated useful life. Same information we had before, okay? The declining balance method. Like all those, go back up here. Okay. Here we have a machine that we said was going to work for 3 years. Okay, 3 years. So under straight line, that would have been 1/3 per year. Remember, 20, 20, 20. How do we get the rate for double declining balance? It's simply double whatever the straight line has. The straight line method would have been. So we were going 1/3 every year. Now we're going to go 2/3 every year. So look at the impact of this. The first year's depreciation is not 20,000, it's $41,667. The reason is we're using double declining balance. We're using 2/3 here, plus we're depreciating the higher number. So of course, the first year, we're going to see a big hit there, okay? And here we go. We started with 62.5. And what was our rate? It was 2/3. 62.5, 2/3 of that is 41,667. Accumulated depreciation here. And this is the net book value. How do we get the next year? We're going to take this new net book value and we're going to take 2/3 of that. So look what we have here. We have a beginning asset investment of 62.5. Under this method, we take 2/3 of the net book value. Next year, we take 2/3 of the new net book value. And the next year, we do the same thing. But we have a little clunker here. We have a bit of a problem here because the net book value fell below residual value. We can't have that. So we're under that amount by $185. Okay. That means that we have to make an adjustment here and reduce this depreciation expense. What we did there is we said we're 185 below residual. Can't do that. So you have to step on this number. You have to take 4629 minus 185. So that's the number we're going to use. Okay. Depreciation expense is limited to the amount that reduces book value to the annual, not the annual, but to the estimated residual value. I am not going to look at this graph here. Now, here's something kind of important in terms of when you start doing your FSA assignment, which I hope to give out Friday after discussion with Professor Alsheimer. A lot of notes on a financial statement. Financial analysts are particularly interested in change of accounting estimates because they can have a huge impact. And we were talking about Singapore. Singapore disclosed in their notes that they had increased the useful life from 10 to 15. Just a change in their policy, but they had to put that clearly in the notes because savvy investors will consider that in valuing this company. And as a result of doing that, they reduced their depreciation expense by $265 million. If you're not looking into the notes and you see that their income seemed to bounce up by $265 million, you might jump in there and start buying the stock until you realize that it was just the result of an accounting adjustment. Tax reporting, not going to worry about that. And the reason we don't go through it is because there's an entire tax course, which I really recommend, taught by Barbara Owie. Asset impairment. There's a lot to this chapter, huh? Asset impairment. If the asset is broken or it no longer does what you expected it to, it has lost some value. It can happen through casualty. Somebody drove a forklift into the side of this thing and ruined it. Or the asset is fine, but it's making a product that nobody buys anymore. You have an asset sitting there, it's not providing any value. You got to look at that. And it's the same thing, lack of demand for the asset's services. You know, if you have an investment in a big machine that makes VCRs, if you remember video cassette recorders, that's an asset that's not going to do you much good. So we recognize the loss when impaired. Now, Friday, I'll go through this a little more. It's not a big part of your test, I don't think, but let's understand the process when we get to it. Now we get to something that will be on the test. disposals of property, plant, and equipment, okay? And they're just telling you two kinds. You can basically give the item away voluntarily. You can sell it, trade it in, retire it, or involuntary. It blew up or caught on fire, accident. What I want to emphasize here is the journal entry to record the disposal of a fixed asset is always the same, okay? Always the same. Just like depreciation expense is always a debit to depreciation expense and a credit to accumulated depreciation, here our journal entry is going to be the same, probably 4 lines, okay? What we have to do is record the cash we received, and we have to remove the net book value from the balance sheet. So that means you've got to go in and credit the original cost of the asset, and then you have to debit the accumulated depreciation to get rid of that. And any difference between the net book value and the cash is a gain or a loss. Let's see if we can make it a little clearer. Disposal of equipment, huh? If the cash exceeds the book value, you have a gain. It'll be a credit. You don't. If it goes the other way, cash is below the net book value, you have a loss on the transaction or no gain if they're the same. So let's see what we have here. Southwest Airlines sold equipment for $5 million. Hey, that's going to be our debit to cash, huh? And they did it at the end of the 17th year. And they were depreciating this equipment that cost $20 million, and they were doing that over 20 years. So the depreciation for 17 years, the accumulated depreciation balance should be 1,700,000. We'll see. I'm getting my decimals mixed up here. The amount of depreciation to record in the 17th year is going to be that $1 million, hopefully, huh? Glad I got that right. Annual depreciation, 20 million divided by 20 is $1 million a year. So that's not too tough. After updating the depreciation, what is the net book value at the end of the 17th year? Well, we bought the equipment for 20 million, and we've now so far depreciated 17 million. So the answer better be A. That is your balance in the accumulated depreciation. So the book value is 20 million minus the 17. There we go. The equipment's gain resulted, well, let's see, what was the net book value? 3 million. And how much did we sell this thing for? Was it 5? Yeah, we sold it for 5 million. The net book value was 3. We better have a gain of 2 million, I hope. Okay. So the net book value was 3, and someone took it off our hands for 5. We made a $2 million gain, a non-operating gain, okay? Well, actually, it is operating now. That's a rule that was changed a while back. Let's go to the journal entry. This is where I want you to see it, okay? So look at this journal entry. You see the debit to cash and the credit to accumulated depreciation? Those are automatics. You're going to receive a check in the mail, and you're going to debit cash. And now you're going to get rid of the net book value of the asset. And that requires you to debit the accumulated depreciation for the 17 million balance, credit flight equipment for 20, and the difference is going to be a gain or a loss. Well, let's see, you have 22 million on this side, and you only have 20 million here, so here's a gain of 2 million. The point is, these four accounts are always going to be the same. I mean, unless they pay you with other equipment or something, but cash is king. That's what we're looking at. So that was a brief look at the world of fixed assets in terms of tangible production type assets. Let's talk a little bit about depletion, okay? Depletion, natural resources, water, oil, timber, coal, gold, silver, okay? It's a non-current asset presented at a cost less accumulated depletion. Notice it doesn't say accumulated depreciation. It's called accumulated depletion. And that's what I'm doing here. This is soda. I'm depleting this bottle. That's all we're talking about. Oh, that's good stuff. So let's continue. The total cost is the acquisition, plus you're going to have a lot of engineering costs and things like that to develop this oil well. But once you've got the total cost, you're going to do it, you're going to allocate by depletion. And you've already learned depletion about 20 minutes ago when you learned the units of production. Remember, we took the depreciable amount, 60,000, and we divided it by 100,000 miles. Here's the same thing, except you're going to be dividing by barrels of oil or ounces of gold or something like that. Acquisition and depletion. Let's take a look at this. The acquisition cost, again, you get rid of the residual value, and that is going to be the amount that you will deplete. And you're going to have an estimated recoverable units. You dig an oil well and you strike oil, your engineers are going to go into that thing. They're going to study it, and they're going to come back to you and say, we think we can get 1 million barrels of oil out of here over the life of this oil well. That becomes your recoverable units, okay? The depletion cost is going to end up on the cost of goods sold side, and the unsold or undepleted goes there. They don't give us a grid on this, but units of production method is the same as depletion, okay? And again, Friday, I'll probably come up with some templates and pointers that would help in these different little areas. Acquisition and amortization of intangible assets, huh? These are non-current assets and no physical substance, okay? And the useful life can be difficult to determine. And if you can't determine it, if you just don't know, you can't amortize it. So that makes things easy in that respect. But what is it? What is an intangible asset? It provides exclusive rights or privileges, and usually acquired for operational use, okay? A patent. You invented a machine, okay? Steve Jobs invented the iPhone, okay? And he got a patent on that. That patent belongs to Steve Jobs and only his company, Apple. And what it means is that only Apple can produce, sell, and benefit from the iPhone. Nobody else can do that for 20 years. And the reason for that should be pretty obvious. The guy who spent all these years developing that product should be able to reap the benefits for a significant amount of time, okay? So Steve Jobs has that patent. So Apple could be the only people selling iPhones, okay? And again, just like with a fixed asset, you maybe have a patent, but there could be other legal fees in there, okay? Patent, a copyright. You write a book, it gets published, it's popular. You're the only person who can collect monies from the sale of that book. And that right goes on for quite a while. A trademark, the McDonald's logo, the yellow arches. That's a trademark. Different things. Let's see what else they tell us here. Acquisition. You have to have a definite life. You have to know exactly how long this item will last, either by your very systematic and rational estimate or according to the accounting rules, according to GAAP rules. So you're going to estimate, you're going to amortize of the shorter of the economic life or legal life using straight line. And what they mean by that, you've invented a product that does some kind of computing. It's intellectual property, and you could probably use this forever. But the way that computers are updated and become obsolete almost immediately means you have to say to yourself, well, yeah, this thing can last for 30 years, but probably in 5 years, someone's going to invent something better. If there's an indefinite life, you cannot amortize it. The only thing you need to do is make sure that it is still providing you some benefits. Otherwise, you're going to have an impaired asset. And amortization is a cost allocation process similar to depreciation and depletion. Let's have some fun with goodwill. Oh, you have a little fun with this. Goodwill. We're going to do some goodwill hunting here. Goodwill is the amount a buyer pays above the fair market value for the company. And notice I said fair market value, not the book value. It's a big difference. Goodwill occurs when one company buys another company, and it's the amount by which the purchase price exceeds the fair market value, okay? And only purchased goodwill is an intangible asset, okay? Goodwill is not amortized. That makes it easy. Its value must be reviewed for possible impairment, of course, like any other asset, tangible or otherwise. Now, let's try to understand this calculation. You need to do a little bit of your homework here and review this till it sinks in a little bit. But here they're asking us what amount of goodwill should be recorded in this acquisition. Well, our PEC company paid $2 million, okay? $2 million for the company. All of UTEC's assets and assumed and to purchase all of the assets and assumed liabilities, okay? So the liabilities are not going to change. When you bought the company, now you have to pay the 1.4 million. But here's the key difference. The acquired assets were appraised at a fair value of $1.8 million. Well, that's what RPEC is going to put on their books, but UTEC might have only had $1 million on their books because they were not allowed to increase their assets to the fair value, fair market value. The whole point of goodwill is when you buy a company, you don't care how they had it valued. You're going to value it the way you think it should be. So in this case here, you're going to have liabilities of 400,000, and the fair value is 1.8 million. The difference between that is $1.4 million. So if there's a God in heaven, $600,000 is the goodwill. So I'd recommend you take a good peek at this slide, maybe take a picture of it or copy it down. Goodwill, the fair market value. The fair market value. This is what RPEC says UTEC is really worth in terms of the market, okay? So they spent $2 million to buy a company they know is only worth $1.4 million. Why would they do that? Why would anybody pay $600,000 more than what a company is actually worth in the marketplace? Well, there could be a lot of reasons. You know, these two companies, perhaps they're competitors. And RPEC has been saying, man, if we can get a hold of UTEC's customer base, we can really pick up our sales here. We could really make the $600,000 goodwill very worth it. Or RPEC is looking at UTEC and saying UTEC's managers are a bunch of morons. They're doing everything wrong. If we took that company over, we could turn that 1.8 million into 5 million in a couple of years. So there's reasons for it. And another big reason is they probably offered UTEC $1.4 million, and Mr. UTEC said, "Get lost. I want 2 million. Take it or leave it." And here they're just talking about different types of intangible assets. Trademarks. Oh, the Visa card, huh? A symbol, design, or logo. It has certain rights. A trademark. Copyrights. This is published material. These are magazine articles. This is books. And a copyright gives you the exclusive right to publish, use, sell a literary, musical, or artistic work. And the legal life is 70 years. So, man, I tell you what, you read a bestseller, you're going to be set, huh? And you amortize over the period benefited. Patents. Let's go back to patents. It's an exclusive right granted by the federal government to sell or manufacture an invention. And the cost of this asset is whatever you purchased it for. Let me point something out that's kind of important here. I said Steve Jobs got a patent on the iPhone, right? And he got from the government a nice diploma looking thing, and he can hang it on his office wall. But guess what? Apple cannot put that patent on their balance sheet. They can't amortize it. And the reason for that, only a company that purchases a patent from another company gets to amortize it. And I'll explain why. Through the years of Apple developing that iPhone, they spent tons of money, right? They spent tons of money on engineers and materials and computer people. And Apple was allowed to take all of that spending, which is called research and development, all of that research and development spending that Apple had to do to develop this machine was tax deductible. It was an expense. So the theory is the person who developed the patent has already gotten a pretty good break, huh? He was able to reduce his net income like crazy by developing this product. And thus it becomes an expense, and he had lower income and lower taxes. Okay. So those costs are borne by Steve Jobs and nobody else. Now, Apple says, okay, I have a patent here, and they're going to keep the patent, and they're going to make the iPhone themselves. So they can do whatever they want with the iPhone. They can make as many as they want, sell as many as they can, charge whatever prices they want, because they are the patent holder. Now, suppose Steve Jobs and Apple invented the iPhone, and Jobs says, look, I don't want to produce this thing. I know how to build it, but we're not in a position to mass produce it. We're not in a position to market it or advertise it. We can't do any of those things. So another company buys the patent from Apple. That company is the one that gets to put patent debit on their balance sheet and credit cash. And they are the ones who will amortize this patent. I guess I just spent a long time trying to tell you something simple. Patents only go to a company who purchased the patent from the inventor, huh? And it has a 20-year life. Technology, that's a intangible asset. Franchises, one of the students in our class, her mom and dad run a local fast food restaurant. They're franchises, McDonald's. Franchising, that's a good way to get the benefit of large-scale advertising and supply chains. It's a pretty tough way to make a living, though. You got to be out there all the time. Licenses, different types of things. Cash flows, we're not going to worry about this, okay? Cash flows. Depreciation is a positive cash flow because it lowered your taxes. Let's not look at that at all, okay? Now, I'm going to finish up today by going through this example, and I'm then going to spend more time on it Friday, okay? You can change your depreciation estimates. If the estimates change, the book value less any residual could be different, huh? A good example is you have a machine and you paid 100,000 for it, and now you spent another 40 to improve it. Remember the improvements? So here, Southwest bought an airplane for 60 million, and they're depreciating it over 20 years, and the residual value is 3 million. But look what happened in year 4. Southwest changed the estimated useful life to 25,000, which they're allowed to do, and they lowered the residual cost to 2.4. Calculate the new depreciation expense. Just take a look at the template for this. It's a little tricky, and you're certainly not going to have to do this whole grid on the test, but you might get a question that says, what's the new remaining book value? What's the new residual? So let's take a look here. Purchased for 60 million. Aircraft was depreciated over 20 years. I guess that's 3 million a year. And in year 4, I'm assuming that's the start of year 4, Southwest changed the life to 25 years and lowered the residual. So let's see what we have here. The original asset cost was 60 million, and the depreciation per year was 2,850 per year times 4 years. So the book value after 4 years was 48,600,000. Now they're saying we have a new residual value. We're changing that residual value, hard for me to say. We're changing the residual value to 2.4 million. So that means your new depreciable base is 46.2 million. Divide by the remaining 21 years. Is that enough to confuse you? It's a little tricky, but essentially what we're saying, you have a current book value. All you have to do is subtract the new residual value, and whatever's left gets depreciated over the remaining 21 years now. It no longer has a 20-year life, it has a 25-year life. Here we go. Time for me to polish my surfboard and hang 10, as we say. What do you think, Brianna? Or did I put you to sleep?
No. Can you go back 2 slides, the actual question for that last one, so I can just review it? Okay. Thank you. Yeah, just that one, so I can reread it and go through it.
Yeah, take your time.
Okay, thank you. No, I took a picture. Thank you.
Any questions, anything?
Nope.
All right, this is gonna be a big test, boys. 6, 7, and 8's a big one, right?
It's a lot of information, but yeah.
You'll get there. Okay, Brianna, I'll say goodbye to you and goodbye to 2:30. And I hope to see more of you on Friday. Okay, guys? Take care.
Yep.
Bye-bye.
Bye.
Bye-bye.